Imagine coming home from a parent's funeral. You're exhausted. You're sorting through this giant stack of sympathy cards on the kitchen counter, and, well, you find a formal letter from a bank.
Right. Definitely not what you want to
Oh,
see.
exactly. And it's demanding, like, $300,000 within exactly 30 days.
Yeah, that is a gut punch.
It sounds like a clerical error, right? But for thousands of families who inherit a home every year, it's actually this brutal legal reality. So today's deep dive tackles, honestly, the ultimate uncomfortable intersection of two super stressful things: death and debt.
It really is a profoundly jarring experience. I mean, for
Wow.
people who just assume that inheritance is, a simple transfer of keys.
Here's the house, enjoy.
Exactly. But it's rarely that simple.
So we are working from this incredibly practical guide we sourced. It's called Mortgages and Matrimony: Managing Home Debt After Death. And our mission for this deep dive is to completely demystify exactly what happens to a house, and more specifically, its mortgage, when the homeowner passes away.
Which is so crucial to understand.
Yeah, because whether you, listening right now, are putting together your own estate plan, or maybe you might one day inherit a family home, having this knowledge is a total shortcut. It's the difference between being caught totally off guard and, being empowered when it actually matters most.
Absolutely.
Because here is the foundational reality we just have to start with. Dying doesn't hit a magical delete button on your mortgage.
No, it really doesn't.
The debt doesn't just vanish. It basically just changes addresses. The bank still expects their money.
Yeah, and we often look at inheriting a piece of property as this massive windfall. You picture getting the deed to the family home, and, well, it feels like a gift.
Sure.
But fundamentally, what is actually happening in the eyes of the law is the transfer of a highly complex legal and financial responsibility.
Right.
You aren't just taking over a physical asset with, like, a cute front porch.
Well-
You're taking over a ledger.
Okay, so before we get into the really messy weeds of inheritance and all those fun family dynamics, we need to establish the baseline. If the debt survives, where does the responsibility to pay that debt actually go first?
Well, if a homeowner has set up a comprehensive legal blueprint, meaning there is a will, the responsibility of the mortgage typically passes directly to the beneficiary who is named for the home.
Okay, that makes sense.
They inherit the property, and they inherit the lien attached to it.
But wait, what happens if there were multiple people on the original loan, like, say, a married couple or maybe a parent who co-signed for an adult child to help them get the house?
So the lenders underwrote that original loan based on the combined risk of all the applicants. But the contract holds the borrowers jointly and severally liable.
Meaning they're both on the hook?
Exactly. If the deceased applied for the mortgage with a co-borrower or a co-signer, that surviving party remains entirely responsible for the ongoing payments.
Wow, okay.
Yeah, the lender does not just, cut the monthly bill in half because one of the borrowers passed away. The surviving co-borrower has to maintain the full amortization schedule.
Ouch. Okay, so let's unpack this a bit more. The source material also emphasizes something called mortgage protection insurance or mortgage life insurance as a sort of first line of defense. I want to look at the mechanics of this because it functions very differently from what most people imagine when they hear the word insurance.
It really does.
Because with traditional life insurance, it pays out a lump sum, right? And the family can use it for groceries or college tuition or the mortgage, whatever they need.
Right, it goes to their general account.
But mortgage protection insurance bypasses the family entirely. So it's not like regular life insurance where the family gets a check. It's more like a VIP direct deposit straight to the mortgage lender, bypassing the family's bank account completely.
Right. That is the defining characteristic of this specific policy, yeah. It's laser focused. Instead of depositing funds into a beneficiary's checking account, the payout from mortgage protection insurance goes directly to the mortgage lender to satisfy that specific debt.
But why restrict the funds like that, though? I mean, why not just give the grieving family the cash and let them allocate it where they see fit?
Because it bypasses the probate process and offers guaranteed structural security.
Oh, interesting.
Yeah. When someone dies, their standard bank accounts can sometimes be frozen, or they get tied up in a estate settlement for months.
Right, the probate nightmare.
Exactly. And if the family was relying on a traditional life insurance payout that gets delayed in all that red tape, well, the mortgage goes unpaid, and the house could literally slip into foreclosure.
Oh, wow. I didn't even think of that.
Yeah, so by having the money wired straight to the lender, it guarantees the physical asset, the roof over their heads, is completely secured.
Hmm.
It just removes this enormous cognitive and financial load during a period of really intense grief.
Okay, that targeted safety net sounds great in theory, but statistically, nearly half of adults don't even have a will, let alone targeted insurance policies.
Unfortunately, yes.
So when that legal blueprint is totally missing, how does the bank actually extract their money from the estate?
Well, this is where things transition into intestacy.
Intestacy, right?
Right. When someone dies intestate, which just means without a will or trust, the probate court steps in and appoints an executor or an administrator.
Okay.
And this person is handed a fiduciary duty to manage the deceased person's assets and liabilities.
Mm-hmm.
And their immediate glaring problem is that the mortgage clock is still ticking.
So if the estate lacks cash, like say the deceased was house rich, but their checking account is, nearly empty, how does the executor actually pay the bank?
The executor basically has to physically liquidate other assets within the estate to generate cash flow.
Meaning they have to sell stuff.
Exactly. This isn't just moving numbers around on a spreadsheet. It means the executor has to hire an appraiser, potentially petition the probate court for approval, and then literally sell off personal property.
Wow.
They might be forced to sell a classic car, or liquid investments, or even items of deep sentimental value, just to satisfy the immediate monthly demands of the mortgage lender and prevent foreclosure proceedings.
That sounds incredibly stressful for everyone involved. I mean, just navigating that while grieving. Let's look at another complex scenario from the text, which is multiple heirs.
Oh, yeah.
Yeah, right? If a house is left equally to 3 siblings, they don't just magically become one single homeowner.
They do not.
Wait, if 3 siblings inherit one house, they suddenly become co-borrowers. That sounds like a Thanksgiving dinner nightmare waiting to happen.
It really can be.
I mean, who actually writes the check? Who pays for the broken water heater?
This raises an important question about the logistics of shared inheritance. Because when multiple heirs inherit, they essentially have 3 structural options to untangle the asset.
Okay, what's the first one?
First, they can all agree to keep the property, effectively becoming joint co-borrowers on the existing debt.
Right.
But as you pointed out, that requires an immense amount of ongoing trust, financial alignment, and a legally binding agreement on who pays for maintenance costs.
Which is exactly why the source heavily emphasizes bringing in a neutral real estate or estate lawyer to draft an operating agreement, rather than just relying on, sibling harmony.
Precisely. You need it in writing.
Okay, so what's the second option?
The second option is a buyout. If only one sibling wants to keep the house, they have to compensate the others for their equity.
Meaning they have to pay them out.
Right. Mechanically, the sibling keeping the home usually has to take out a brand new mortgage in their own name. And they use those new loan funds to simultaneously pay off the deceased parent's old mortgage and pay their siblings the cash value of their inherited shares.
That makes sense. Clean break. And the third option is just selling the property outright, paying off the bank and splitting whatever cash is left over.
Exactly. The simplest route, usually.
But wait, what happens when the legal hunt for an heir turns up absolutely nothing? Like, the homeowner passes away, there's no will, no spouse, no children?
Yeah, so in that case, a public administrator steps in and begins this forensic genealogical search.
Like a detective?
Basically, yeah. They dig through public records, ancestry databases, and contact distant jurisdictions trying to find anyone with a legal claim to the estate.
And if they find nobody?
If that extensive search is completely unsuccessful, the legal concept of a sheet applies.
A sheet, okay.
Right. The assets, including the real estate, are simply absorbed by the state government where the property is located.
Wow. Okay, so we've covered the broad mechanics of inheritance, but the source material zeroes in on 2 very specific, highly regulated demographics that I think require a closer look.
Yes, definitely.
First, surviving spouses, and second, elderly homeowners utilizing reverse mortgages. Let's start with the spouses. If a husband and wife live in a house, but only one of them was technically listed on the mortgage note and that person passes away, how exposed is the surviving widow or widower?
Well, historically, they were highly exposed to foreclosure. But modern federal regulations have built a sort of fortress around surviving spouses.
Okay, that's good.
Yeah. If the surviving spouse was not on the original mortgage, but they inherit the property or hold a legal interest in it, federal law prevents the bank from simply calling the loan due.
Real?
Yeah, they are legally allowed to formally assume the mortgage and keep the home.
But assuming the mortgage doesn't mean the debt gets restructured automatically, right? They still have to make the monthly payments. What if the widow was relying on a dual income and simply cannot afford the current amortization schedule?
That is where the right to a loan modification comes in. Federal rules mandate that the lender must evaluate the surviving spouse for a modification.
What does that look like mechanically?
Mechanically, this means the bank might re-amortize the loan like, extending a 15-year term back out to 30 years, or they might lower the interest rate. The goal of the mechanism is to get the monthly payment down to a figure the single surviving spouse can actually carry, preventing unnecessary displacement.
That provides a huge layer of compassionate protection. I love that. But then the source material shifts to reverse mortgages and the tone changes completely.
Yeah, completely. It's a different world.
Right. So a reverse mortgage allows homeowners, usually over the age of 62, to convert their home equity into cash without monthly payments. But what happens when the last surviving borrower passes away or, say, moves permanently into a care facility?
That permanent departure is the trigger event. In a reverse mortgage, the loan balance instantly becomes due and payable.
And the heirs receive a formal notice from the lender. But the timeline here is what genuinely stands out, because only 30 days.
That's 30 days.
That is a brutal ticking clock while you are in the middle of grieving. That's barely enough time to secure a death certificate and plan a memorial, let alone hire a realtor, list a house, and close a real estate transaction.
It is incredibly fast. But what's fascinating here is the underlying financial mechanism driving that ruthless timeline.
Why are they so fast with it?
Well, in a traditional mortgage, the bank relies on a steady stream of monthly cash flow. But in a reverse mortgage, the bank has been advancing cash to the homeowner for years.
Right.
The physical house itself is a repayment vehicle. Once the borrower vacates, the bank's capital is trapped in an empty, potentially depreciating asset with no monthly cash flow coming in to offset the risk. So the regulatory framework allows lenders to demand rapid capital recovery to mitigate their exposure.
So families need to be acutely aware if their elderly parents hold a reverse mortgage, because that reaction window is unforgiving.
Very unforgiving.
Let's pivot to the mechanics of inheriting a traditional loan. If you decide to keep the family home, how do you actually take over the debt? Because a lot of mortgages contain a due on sale or due on transfer clause.
Yes, they do.
Meaning if the title changes hands, the entire remaining balance of the loan has to be paid back immediately.
In a standard market transaction, yes. If you sell your property to a stranger, that clause triggers, and the stranger's purchase funds are used to satisfy your old mortgage.
Right.
And heirs often see that clause in their parents' loan paperwork and panic, assuming the bank is about to demand the full balance tomorrow.
But the source assures us that federal law, specifically the Garn-St. Germain Act, overrides those due-on-sale clauses when a property is transferred to a relative due to death. Lenders are legally mandated to allow family members to take over the loan.
So, mechanically, what are the heirs' options to actually handle the existing debt?
You essentially have two standard paths and one major exception.
The first standard path is to refinance. If you want the house but need different terms, you apply for a new loan to replace the old one.
But refinancing isn't just signing a piece of paper. I mean, the bank treats you like a stranger off the street. They're opening up your entire financial history, your debt-to-income ratio, your credit score, your pay stubs, to see if you, personally, can float the loan.
Exactly. You are subject to full, modern underwriting standards. The second standard path is to sell. You put the house on the market, use the buyer's funds to pay off the inherited mortgage, and you pocket whatever equity remains.
But that deficiency judgment mentioned in the text introduces a huge risk here, though.
It does.
Because the house is underwater, meaning, like, the deceased owed $400,000, but the house is only worth $350,000, and the heir just walks away. The bank forecloses, sells it at a loss, and can potentially sue the estate for the $50,000 difference.
That is the mechanical risk of an underwater asset, yeah. But if the house has equity, and the heir wants to live there, we arrive at the third option. And this is the massive exception to the standard rules of banking.
This is my favorite part.
Yeah, the source material highlights that heirs can simply assume the inherited mortgage without having to prove their ability to repay.
Here's where it gets really interesting. Assuming the mortgage without having to requalify is kind of like inheriting an exclusive club membership and getting to walk right past the bouncer.
That's a great way to put it.
You completely bypass the underwriting process. Instead of the bank tearing the engine apart to see if you qualify for a new loan, you just take the keys and keep driving the existing loan. You take over the exact same interest rate, the exact same monthly payment, and the exact same remaining term.
And if we connect this to the bigger macroeconomic picture, it becomes clear why lawmakers created this loophole. The ability to repay rules were designed to protect consumers from predatory lending. But applying those strict rules to grieving families would be catastrophic. Imagine an era where interest rates spike to 8 or 10%.
Oh, wow. Yeah.
If a daughter inherited her mother's house with a low 3% mortgage and the bank forced her to requalify at the new massive 8% rate, she might fail the underwriting test and lose the home.
It would inadvertently trigger mass foreclosures and completely destroy generational wealth transfer for middle-class families.
Precisely. This exemption ensures that banks cannot unfairly strip assets away from families just because an heir's credit score isn't perfect in the immediate aftermath of a death. It stabilizes communities by allowing wealth to transfer seamlessly.
Okay, but just because you can take the keys and keep driving doesn't mean you can afford the gas and insurance.
Oh, absolutely not.
Inheriting a house is not just inheriting a monthly principal and interest payment.
Right. Inheriting a physical structure comes with immediate, unavoidable holding costs. You are instantly responsible for the annual property taxes. Yeah. You must maintain comprehensive homeowners insurance, which, by the way, might need to be rewritten if the property is vacant during probate.
Oh, that's a good point.
If the home is in a managed community, you are on the hook for the homeowners association dues. And crucially, you inherit the deferred maintenance.
The broken stuff.
Exactly. If the HVAC system fails a week after the funeral, that capital expense falls entirely on the heir.
Okay, let's talk about the friction of the actual process. Say a listener has run the numbers, they can afford the holding costs, and they want to assume the loan using that federal loophole. Finding a lawyer makes sense, but the text mentions gathering the documents.
Yes.
That sounds incredibly bureaucratic. If you can't find the physical deed in your parents' filing cabinet, are you just stuck?
You are not stuck, but you definitely have to navigate the local bureaucracy. A deed is a public record.
Okay.
Mechanically, you or your attorney must go to the county clerk or recorder's office in the jurisdiction where the property is located and request a certified copy of the recorded deed.
That doesn't sound too bad.
No, but you will also need to secure certified copies of the death certificate from the state's Vital Records Office and prevent the probated will or letters testamentary proving you are the legally recognized executor or heir.
Only then do you approach the mortgage servicer to officially initiate the assumption process.
Exactly.
Which brings us to the ultimate takeaway. So what does this all mean for you, the listener, right now? Whether you are the one eventually leaving a house behind or the one who might inherit it, how do we build a pregame plan so we aren't scrambling through county clerk offices while trying to plan a funeral?
The source material lays out a really clear roadmap for proactive planning. First, prioritize comprehensive estate planning.
Get a will.
Yes. A legally sound trust or will does not just dictate who gets what. It establishes a clear chain of command, completely bypassing the chaotic intestacy process.
Right.
Second, have transparent conversations about the math. Ensure your heirs know exactly where the deed is, who the mortgage servicer is, and whether the property is subject to a reverse mortgage.
So no 30-day surprises.
Exactly. Finally, evaluate your safety nets. Look at the structural differences between traditional life insurance and mortgage protection insurance and just decide which mechanism best serves your family's liquidity needs.
It really all comes down to stripping away the ambiguity before a crisis hits.
It does. Ambiguity is the enemy of a smooth transition.
Let's briefly recap the journey we just took. We started by establishing the foundational rule that mortgages outlive the people who sign them.
They do.
We looked at how wills and targeted insurance policies serve as the first line of defense. We waded into the messy mechanics of intestacy, where executors are forced to physically liquidate assets, and explored the complex buyout options for multiple heirs.
The Thanksgiving nightmare.
Exactly. We examined the brutal 30-day timeline for reverse mortgages, contrasted with the federal protections designed to keep surviving spouses in their homes. And finally, we uncovered the federal loophole that allows heirs to assume a loan, completely bypassing the bank's underwriting process before breaking down the hidden holding costs.
We covered a tremendous amount of ground. And as we wrap up, I want to offer a final lens on the material.
Please do.
We often think of passing down a family home as passing down a legacy of love and memories. It's the height mark scratched into the door frame, the holidays spent in the living room.
Yeah.
But structurally, you are passing down a highly regulated financial entity. The provocative thought to leave you with today is this. Your house is deeply emotional to your family. But to the legal system, it is purely a ledger of debts and assets. When you take the time to build an estate plan, you aren't just distributing property, you're actively curating how much peace of mind your loved ones will have while they grieve. You are doing the heavy administrative paperwork now, so they are free to just be human later.
Doing the paperwork now so they're free to just be human later. I love that because, as we established at the very beginning, dying doesn't magically delete your debt. But with a clear understanding of the mechanics, you can absolutely make sure it doesn't delete your family's financial future either. Thank you so much for taking this deep dive with us today. Stay curious, keep learning, and we'll catch you next time.